Everybody, good morning. We'll get started here in just a minute. Just have a little technical issue, so I want to make sure we're up and running here. All right. Well, I think we'll go ahead and jump into it. So first off, I hope everybody is enjoying their Sunday. Thanks so much for joining us in this live session here this weekend. I think that we wanted to just take a few extra minutes on top of our typical weekly updates to talk a bit more about the Fed. And hopefully in kind of like a all-in-one package. We talk about the Fed each week lately, really, but certainly each month as that decision comes up. But what I've realized is that we don't necessarily have a place where we can really just talk about everything that's happened up to this point and what may be ahead. So that's really going to be our focus for today, is really all about the Fed, but really breaking it down a little bit more to go all the way back to the beginning of this rate hike cycle anyways, and then kind of put in perspective what has happened and what most recently happened and what is likely to happen from here. So again, thanks so much for joining us on this Sunday. Special happy Father's Day shout out to all the dads out there. And I want to thank everybody again for tuning in here this weekend. So I think that the way I just framed it might be a good way to kind of shape the conversation today. We'll start with kind of looking back, and then we'll move into the most recent, and then we'll talk about what's ahead. But before we even get into this most recent Fed rate hiking cycle, I want to back up even further and just kind of refresh a little bit on what the Fed is even here to do. So as a quick refresher, I think a lot of us probably know this at this point, but again, the more that the Fed has been in the spotlight, I think that the conversation of what they're really designed to do or what their role is in the economy has kind of, I guess become almost a little bit on the back burner, I guess, through all of this. So as a quick reminder, the Fed's mandate is really twofold. It's around inflation, keeping inflation at a moderate level, and it's around jobs, keeping the labor market strong. So obviously, with what has gone on over the past couple of years or so, this has been a hot topic item, and the Fed has been at the center of all of this focus because obviously jobs, first off, are very strong. In fact, the Fed, might even argue too strong, and inflation has been running at rates that we haven't seen for a very, very long time. So here enters the Fed, right? Here's where they kind of come into the picture to say what tools do they have and what can they do to try and right the ship here a little bit to hopefully tame inflation a bit. Now, keep in mind, this doesn't necessarily mean going back to where we were. When we talk about taming inflation, the goal is to actually run at a lower rate of increases, not necessarily to bring prices back down. And if it helps, what I want to maybe share is to back way up to where we started this conversation with the Fed kind of, entering the forefront here, which actually goes all the way back to 2020. So kind of picture in your head, although I don't think any of us can get this out of our head, but go back to February, March of 2020 and enter COVID, right? We had a huge pandemic that we were all dealing with. And in addition to that, a lot of economic challenges that we were all dealing with as well. And really, this is where the Fed started to really be a big player in the markets and in the economic cycles here. So back then, in March of 2020, the Fed actually reduced rates. And I forget exactly, but it was a pretty big reduction when they started this pullback because they were trying to stimulate the economy and create some more growth and basically put some Band-Aids on a very difficult situation is the reality, right? What I thought maybe is interesting to share for where we started this was that actually during that period, you may remember that the Fed was talking about inflation running too low. They kept talking about this 2% target. And for those who listen to us pretty frequently, you might remember we actually talked about this as one of our questions of the week in our weekly updates, which is like, why are we targeting inflation in the first place? So I'd love to hear if anybody has thoughts, feel free to put it in the comments. Maybe we can talk a little bit about this. But the idea of targeting inflation, I thought was a really interesting dynamic, I guess, of what they were doing. And part of why they were reducing rates was to try and target a higher inflation rate in the first place. I don't know that there's a lot of information out there to say that inflation is good for the economy in any way. So it was really interesting that this is where it all started. right? Now, again, go through COVID, and this probably, had a little bit of an impact on things, but certainly, markets ended up taking off. We had a big pullback through 2020. They ended up taking off 2020 and 2021. Labor market's been extremely strong. We pumped in the most amount of money in the economy that we've ever seen. And here we are, 2023, June of 2023 with, persistent inflation problem. But it started a ways back. And so actually the Fed, all the way back to March 2022 is when they started to raise rates to try and deal with this inflation problem that was starting to, show some signs of really being an issue. And you may remember the Fed kept using this term transitory. So actually, we had inflation running long before March of 2022, but the Fed kept saying this is transitory. In other words, it's going to go away. It's temporary. Fancy word maybe for temporary. And it certainly hasn't, right? Not only are we a year and a half later into this, where it's still here, but obviously, even into March 2022, the Fed finally realized that maybe this thing wasn't as temporary as they thought. And that's when they began the rate raising cycle. Now, my opinion is that the reality is they did this a little too late. They started this conversation and this cycle a little too late in the system. And so what ended up happening was they had to play a lot of catch up. So you probably remember, but the rate hiking cycle actually started a little bit slower. And then all of a sudden they started doing, 50% or 50 basis point, 75 basis point hikes. In fact, there was a period of 75 basis point hikes all the way through late 2022. Through 2022, they raised 4.5% from March until December. So a huge increase, and it slowed down through 2023 to 25 basis point hikes, all the way up until this last session, basically. But we got up to 5.25%. So it's the fastest we have ever seen rate hikes in the history of the Fed. Not the largest rate hike cycle, but the fastest, right? All right, now let's look into the last meeting. So fast forward all the way, here we are 5.25. Last meeting was in May of 2023, and actually we were at 5%, at that point. And the Fed hiked another 25 basis points. But what was very different in this press conference was the tone that the Fed had kind of shared. They were certainly very clear that they were going to deal with rate hikes until the inflation problem at least slowed. But there was a lot of conversations of like, well, if this and a lot of kind of like pulling back on their heels a little bit to play a little defense. So the tone was certainly a lot different. And on top of that, you may remember that just prior in mid-March or so, we had a lot of the banking turmoil really take off. So although the Fed's two mandates are inflation and jobs, the reality is that they also have this kind of third overarching mandate as well, which is to keep the economy strong and make sure that, but that the economy is functioning, maybe is a good way to put it. And so I think the Fed saw that, got a little spooked, and was maybe more worried than they let on at first anyways, that this could be a bigger issue. Of course, here we are in June. It looks very likely that this is not nearly as widespread as maybe the Fed had been concerned about. But nonetheless, 25 basis point hike in May and a much softer tone about what may come. Now, fast forward to this most recent session. So here we are just this last week in June of 2023. And the Fed decision was to not hike rates in this session. And what I thought was interesting before I get to the press conference part of it is that just from the dot plots and some of the information that came out, nearly all members of the Fed felt that it was going to be necessary for more hikes to slow inflation ahead still, right? So in fact, the dot plot shows 50 basis point more hikes through the end of the year. So if you just looked at the decision on the surface and just looked at it purely in data form, you would say, well, things are moving ahead here, no question, right? This is a pause, or a skip, not a pause, which I'll get to here in a minute, because all the Fed members believe that we need to still continue to hike. And in this example, 50 basis points more, which is 0.5% more than we're at today, to get inflation to a manageable level. All right, so then we have a little break and the press conference begins. And basically through the press conference, there was a lot of kind of quotes that I wanted to take away from that. One of the things that Fed Chair Powell had said time and time again was that the full effects of their tightening have not yet been felt. So obviously they are a little bit concerned based on that comment about the economy and the impacts of what that may mean, not just to inflation, but I think just to the broader markets as well. They also shared that getting inflation back down to 2%, again, that target that I mentioned right at the get-go, is a long way from here. They have a long way to go to get back down to 2%. Core, they also pointed out that core PCE is really the measure that they're watching. So again, especially for those who pay attention to our weekly updates, there's two numbers we always look at on inflation. There's the headline number and the core number. So whether that's CPI, PCE, you name it, all of these inflation data points have a headline number and a core number. And to really simplify it, what that means is the core takes out the volatile items of inflation. So really, food and energy is the best way to think about it. Core inflation takes food and energy out of the headline inflation number. And so the Fed really was pointing towards these core numbers as the number to watch to really understand where inflation is headed, as opposed to some of the more volatile, items. I mean, we all know that the price of oil has dropped significantly, actually, over the past, few months or so. And so when you strip that out, inflation is still running quite high. So that was really interesting, I think, as well. And what I thought was actually very relevant that I don't know got a lot of attention, but I was paying very close attention as he was talking. He did say, and I think, I don't think, it was a slip up. He said specifically that this was a skip. And as soon as he said the word skip, he put a pause on things and said, actually, I should not use the word skip. I'm sorry, I mean pause, we'll reassess. But skip obviously tends to infer that means that there's another hike coming next meeting. So again, I think when you look at the data and then you look at the set press conference portion, not the questions, it all seemed very clear that the Fed was going to hike coming up. Sorry, joy of doing these from home. But it was very clear the Fed was going to hike coming up in the next meeting. Now, then we began the questioning. And I think what happened as we started going through some of that questioning was the Fed began to backpedal a little bit. It was much more defensive, I think, as he started answering some questions from the press. And through that conversation, clearly the markets believe that the Fed is either bluffing or they're done, right? I mean, really, if you look at what happened Wednesday, really Thursday is probably the biggest day to pay attention to. The markets basically took off. And so they said, you know what, we're calling your bluff. We believe that you're done and we're going to be able to move past this. But I think what is important to know is to remember that Fed Chair Powell is not the Fed. He is the one that speaks for the Fed, obviously has a big role in the Fed, but nonetheless, if a huge majority of Fed members are suggesting 50 basis point of hikes still through the end of the year, that tells a little bit of a different story. So all this to be said, though, is I think the thing to take away is that there's a lot of time still between now and that next meeting. We will still have inflation data. We will still have jobs data. We'll have all this stuff kind of slip through over the next few weeks here. And so we obviously need to continue to watch this. But it's very clear to me that if the inflation data and the jobs data stays anywhere near where we are today, that the Fed's going to hike again in July. So again, there's so much time. It's very hard to say exactly what that might mean and exactly what to expect there. But my takeaway from the press conference last week was that as long as inflation continues to persist, which I expect it may still for a little bit, that they will hike in July. If it does come down, maybe that's the sign that the Fed can actually move on and we can stop talking about them. But in the meantime, I think we need to continue to focus on the Fed here, at least for the next month. Although, I felt that way last month too, so we'll see. But I guess, as far as to wrap this all up and talk about what that means next, again, remember to come full circle, the Fed's mandates are twofold. It is inflation and it is the labor market. So right now, again, there's a lot of time, but right now with the labor market being extremely strong, we can almost take that off the table. Obviously that could change in the next month, but the reality is that for the labor market to change that significantly, that the Fed actually factors that into their decision in a month, I think is very, very unlikely, if not almost off the table. The second, of course, is inflation. And here we are, if we look at the most recent PCE data, CPI data just from last week, right before the Fed meeting, it showed core inflation was still, over 4% year over year. So it's very important to watch this. Again, don't pay too much attention to the food and energy part of it, because that did come down a lot. But again, the price of oil has come down significantly and has a huge role in this. We really want to focus on that core. So if that core PCE number or CPI number stays anywhere near where it is today, I expect that the Fed will hike again in July. But one thing I will share is a little bit of a caveat to this. Again, when we talk about the history of the Fed and what's gone on in this cycle at the beginning of the conversation, their job is to decrease this inflation rate. That is what they're trying to do, and they've got some tools in their tool basket to do so. One of those is hiking rates. Now, to be clear, I do not think that that's the most effective way of doing this. I think that it has an impact, but it's a more delayed impact and has some other consequences along the way as well. Simply hiking rates doesn't necessarily mean that inflation comes down. However, money supply is another area that they really focus on. And what has been interesting is that in all of these Fed press conferences, conversations, you name it, there's never any talk of money supply, but my opinion is that that is the biggest impact on this inflation data. And what I will share as a bit of a glimmer of hope in all of this is that the reality is that money supply has gone down significantly. So I don't expect that to necessarily carry through to the inflation data in the next month. We will see. I don't have the crystal ball there. But I do think that inflation is likely to start simmering a little bit in the near-ish future. Now, again, if that makes a big enough difference on the June inflation numbers, we certainly could see the Fed back off. Again, likely, I think that it may take a little longer than that. And so if that's the case and inflation is still running high, I think it is most likely that we see the Fed hike again in July. So we'll continue to watch this. Again, there's so much data, so much time still between now and next meeting that it's hard to say exactly where things will go. But this is going to be the kind of primary focus is on the inflation data. And that will, I believe, tell the story of what comes in that July Fed meeting. So thank you guys so much for joining us here this weekend. Again, happy Father's Day to all the dads out there. And hopefully this was helpful. Again, we wanted to just kind of package all of this Fed data into one kind of easy to digest, but thorough, data point here or conversation so that we can kind of remember where we're going, where we came from, and what may be ahead. Thanks again for joining us. Have a great weekend, and let us know in the comments what you think the Fed will do here in the next meeting. I'd love to hear your opinion and kind of start a conversation.